All right, inventory. Inventory is, there's two steps to an inventory problem. The first is determining how often are you going to account for the inventory. All right? There's two options there. There's periodic and perpetual. Periodic is, as it means, is doing it once a month at a minimum. Maybe even once a year sometimes. What that is at the end of the period when you want to calculate how much inventory has been sold, you go out and count what you have left. You go out and you do a physical inventory. And you count everything that you have on the shelf, everything that you have in the warehouse, everything you have. All right? That gives you ending inventory. You know how much you had the last time you counted. That was beginning inventory. You know how much you bought from all your suppliers, or if you're a manufacturer, how much you made. That's purchases. Or finished goods. If you add those two together, you have all goods available for sale. You know how much in total that you have to sell to your customers. You just went and counted how much you have still on the shelf. So the difference between the total pie of goods available and how much pie you have left is cost of goods sold. This is under a periodic inventory system. It is the simplest system out there. It is what has been used for centuries. You know how much you had available during the period, and you know how much is left over. Everything else has to have been sold. Now we all know not everything gets sold, even though it's no longer on the shelf, right? There's what retailers call shrinkage. You know, people who walk through the H-E-B and open up packages of Oreos and eat them on their way to the grocery, to the counter, right? Oops, they're gone. Shrinkage. This does not account for shrinkage. It's one of the flaws in this system. There's no way to tell how much was, people knock stuff off the shelf and break it. You know, clean up in aisle 3. There's no way of telling how much was damaged or stolen. Which is why, with the advent of the modern computer system, even small mom and pop stores can have a perpetual inventory system. Because there's barcodes now. I mean, even the little dive shop that I go to, they only have 2 locations in town. It's a family-run business. They barcode their inventory. Every time they get something in from the UPS guy, drops it off, they open the box, they barcode the inventory in. When I go down there and buy something, they sell it to me and they barcode it out. That's a perpetual system. They know at any point in time how many items they have left. Always. HEB, when you go check out, they know how many loaves of bread are left on the shelf by looking at the computer. And this is the way most companies, not all, most companies do their inventory now. All right? So does everybody understand the difference between periodic, this calculation, and perpetual? Because this calculation, you only do a cost of goods sold, debit cost of goods sold, and credit inventory once a month. No idea of shrinkage. Under a perpetual inventory system, I can go out and do what is known as a cycle count. I can go out at any day of the week, anytime it's slow, and I can count one shelf. And if it doesn't tie to my records, what's happened? Shrinkage, right? If I go count, and I'm supposed to have 43 loaves of bread on the shelf, and I've only got 40, where'd the rest of it go? Okay? So you can continually, it's a much better system, and with the advent of a modern computer system, you can count all the time. Do cycle counts. Back when I was in the aerospace, I always had cycle counts going on because in most companies, 90% of the value, dollar value in your inventory is made up with 10% of the items. Go keep track of the really expensive stuff. Always know where the high-end actuators and the avionics equipment and the instruments and the stuff that's really expensive, $10,000, $100,000 plus. Make sure you keep track of that. If you lose 10% of your rivets, okay. I would rather not lose it, but, I can deal with that. That's $30 maybe. Okay? So really track under a perpetual system what you've got in inventory. So we're going to go over both an example of perpetual and periodic. Now that's just how often do you account for inventory. The next thing is how do you cost it? Well, what's going on there? Here too, there's options. There is specific identification. There's FIFO. There's LIFO. And there's average cost. Specific identification is on every item that you have in inventory exactly what it cost you. That one item, you know exactly how much it cost. So that when you sell that one item, you can account for it. Now, this is not how they keep track of the bread at the HEB store. But if you were an art dealer, dealing in high-end paintings and statues and stuff like that, you would know what every one of those items cost you. If you were a jeweler and you were dealing in diamonds and rubies and emeralds, you would know what each and every stone cost. Because they all cost something different. They're not homogeneous. They're not all the same. Diamonds actually have a microscopic serial number etched into them now that you can only see under a microscope. It's to prevent what they call the conflict diamonds, where there's somebody at war and they've got children mining and down in the mines, and they don't want those out in the market being sold. So they etch onto the side of the diamonds. All right? That's specific identification. We're not going to cover that on the exam because it's easy. I tell you what the item cost. FIFO is first in, first out. That means the oldest item in inventory is what you sell. Right? So as the inventory comes off the production line or as the inventory comes into the delivery truck, loading dock, those are the items that you're going to sell first. You sell them in order. Okay? The example that I used to use for this one is that bread, back to bread at H-E-B, when they deliver more bread, what do they do with the old bread? They put it in the front. They put the new bread in the back, right? That's first in, first out. That's a bad example. Because when I go to H-E-B, that's the bread I buy. Because I'm there trying to get it in a dash. I'm getting out of there as quick as possible. I just grab the bread on my as I fly by. What bread does my wife get? The one in the back. Exactly. She'll send me back to the bread aisle. Who knew? They're different colors on the little twisties. Tells you what the new bread versus the old bread. They change the colors every day for the bread. Who knew that? I don't need to know that. And I'm the one that eats the bread, so who cares? But that didn't work. What works is the candy machine. The little corkscrew candy machines. You put 65 cents in and you push G4 and you get your Snickers bar. That's FIFO. Because when the delivery person comes and refills that candy machine, they open it up and swing the whole thing open and they fill it from in the back. So you cannot buy the newest candy bar in the machine. You have to buy the oldest one. Which they also kind of make these machines with sandwiches in it. So remember, you're getting the oldest sandwich in the machine. There's no way around it. Okay? And the crackers and all the rest of it. It's the oldest one. That's FIFO. Okay? There's no way around it. So what's LIFO? Last in, first out. What that means is the newest piece of inventory is what is being sold first. Now, what's an example of that? Back to H-E-B. Big pyramids of beer. You've all seen them, right? They stack the beer up in a big, huge pyramid for the Super Bowl. And when you go in and buy it, do you reach to the bottom and get the newest beer? No. You get the one off the top. And when they replenish it and put more on the stack because the stack gets sold down, do they pick up the stack and put the new beer on the bottom? No. They just stack it on top. So you're getting the newest beer, or the newest pumpkin, or the newest watermelon, or the newest whatever. Because the new stuff just gets piled on the old stuff. Okay? That's LIFO. Average cost is the last one. This one it doesn't matter when it was bought. Because at all times, you take an average of all the inventory that you have available for sale. And that's what you cost. The example I use here is a gas station. Gas station sells diesel fuel and 2 at a minimum, sometimes 3 different grades of gasoline, right? So they've got 3 separate tanks underground that holds the gasoline, the fuel. When the delivery truck comes in, they just hook up a big pipe and they pump it into whatever they're delivering, whether it's the high octane or diesel or whatever. And it all gets mixed up together. So you're buying a little bit of today's gasoline and a little bit of last week's gasoline and a little bit of last year's gasoline. You're buying a whole mix of gasoline. That's average cost. Okay? LIFO is the only one that it doesn't matter. I'm sorry. FIFO. FIFO is the only one that it doesn't matter if it's periodic or perpetual. It will give you the same numbers because you're selling them in order. So it doesn't matter whether you make a cost of goods sold entry every time you make a sale under a perpetual system, or if you do it once a month under a periodic system. You're going to sell them in order. Under LIFO and average cost, it makes huge differences. It makes big differences whether or not you use periodic or perpetual. Okay? All right, let's do some examples. We'll start out simple. Exercise number 3 on page 303. On this one, it is a perpetual inventory using FIFO. It says, beginning inventory along with purchases and sales data for portable DVD players are as follows. And then it gives you the beginning inventory at the 1st of June, 2 purchases throughout the month of June, and 3 sales throughout the month of June. And it tells you on the beginning and purchases how many units you started with or you bought and how many dollars each unit cost. And then it just tells you how many units you sold. All right? So they want you under a perpetual system to determine the cost of merchandise sold and what the ending balance is at the end of the month. All right? So, under a perpetual system, you're going to have, we're going to start over here. Here's our inventory. So we have quantity, cost, and total. All right, we started the month on June 1 with 240 units that cost $78 a piece. Multiply those out, you get $18,720. That's what we have in inventory. On June the 10th, we sold some of this. We only have one batch of inventory, all 240 units, so at this point, it doesn't matter whether we use FIFO or LIFO or even average cost. There's only one set of inventory to sell. So we're going to sell, and we're doing FIFO right now. So this is all FIFO. We're going to sell 180 units that cost $78 for a total of $14,040. That's going to leave us with an inventory of 60 units left at $78 for a value of $4,680. That's what we have in inventory. We then, on the 15th of June, buy some more inventory. We buy 280 units at now $80 a piece for a total of $22,400. That's what we have in inventory. Now we've got two layers. We've got 60 units that cost us $78, and we've got 280 units that cost us $80. Now it's important which of these two units, depending upon whether we do FIFO or LIFO, and I'm going to do LIFO next, as to which units that we next sell. And our next sale is on the 20th. And we're going to sell a total of 220 units. So, under first in, first out, which 220 units are we going to sell? You're going to work your way from the oldest to the newest. This is the candy machine. All right? So we're going to sell the 60 units that we still have left over from the beginning of the month that cost us $78 for $4,680. That leaves us 160 to identify because we sold 220 in total. Well, the only inventory we got left is the $80 inventory. So we're going to sell 160 units at $80 for $12,800. And that's going to leave us with 120 units that cost $80 for a value of $9,600. Everybody with me so far? On June the 24th, we're going to sell another 90 units. We only have one batch left, so it had to have cost us $80. That's $7,200, leaving us with 30 units at $80, or $2,400 in value of inventory. See how this works? We then buy another batch on the 30th. We buy 320. Now they're costing $86. And that is $27,520. And the month ends. So what do we have left at the end of the month in ending inventory? We have 350 units at a total cost of $29,920. What did we sell throughout the year or month? $38,720. That's the total of the $14,440, the $4,680, the $12,800, and the $7,200. The total of everything we sold under FIFO, first in, first out. Yes? What if we were doing this under LIFO, which is exercise number 4 on the same page? Oh, has everybody got this? Oh, I just erased the top line. Hopefully you have that one already. Okay, good. Okay. All right. We still start the month with 240 units at $78. So when we sell on June the 10th, we still, under LIFO, we only have one set of units. So it is still at $78, 180 units for $14,040. That remains the same. Then on the 15th, we buy 280 units at $80. Now here's where it gets different. On June the 20th, we sell 220 units. Which units are we now selling out of the big pyramid of beer? We're selling the newest ones in inventory. So that 220 units are all from this $80 per unit batch for $17,600. So what that leaves us is we still have the 60 units at 78 for $4,680, but now we have 260 units at 80 for $4,800. Now that's what we have in inventory. That because we need some more room here. So when we sell on the 24th, the 90 units, which units are we going to sell? Well, this 90 units is going to be made up of the remaining 60 units at 80 for $4,600 or $4,800. And then 30 units at 78 for $2,340. Leaving us in ending inventory 30 units from what we started the month with at 78, 2,340. So when we come in on June the 30th and we buy the last 320 at 86, we have 27,520. Add those two together, we have 29,860 we still have 350 units, only now they're worth 29,860, not 29,920. And the total here is now 38,780, where it was 720 before. So under LIFO, because we're selling the most expensive units in inventory, we wind up with, rather than 30 units at $80 a piece, we wind up with 30 units at $78. So that's the $60 difference, is that we're now putting it into cost of goods sold rather than the value of ending inventory on our balance sheet.
Wait, sir.
Yes?
I kind of get it, but not really. Would you mind just breaking it down a little bit more?
Yep. The difference between LIFO and FIFO is that LIFO winds up with what is known as LIFO layers. Because every time you make a sale, you're selling the newest ones. And so you don't always get to the oldest layers that are in inventory. All right? You know, the bottom 15, 12 packs of beer could be there for months, is really what it comes down to. Because they keep stacking new stuff on top of it. And so those LIFO layers are in a traditional inflationary times where as you buy new inventory, it becomes more expensive, more expensive, and more expensive. You're expensing the new stuff. So you're charging to the income statement more than you would under FIFO. Because under FIFO, you're selling all the old stuff in inventory. So organizations, and it's worth stating, the physical flow of inventory does not have to match the cost flow of inventory. And I'll give you an example. LIFO is not allowed in the rest of the world. Under the International Financial Reporting Standards, they do not allow LIFO inventory. So nowhere except the United States do we have LIFO. But industries in the United States that use LIFO, almost exclusively, one of them, the biggest one, is the petroleum industry. Because they want to match the current price of a barrel of oil to their cost. They want to reflect whatever the price was yesterday. It didn't matter what oil they made the gas that they're selling today. It didn't matter what that barrel came out of. They want to know how much does it cost me now. So they have these huge LIFO reserves of this oil. Sometimes it's more expensive, sometimes it's cheaper. But they have these LIFO layers, which is one of the reasons I don't think the United States will ever adopt the international rules, even though we've promised the world that we would. We're not going to do it. And that's the main reason, is that for tax reasons, they have to match their inventory. So whatever inventory they use for tax, they have to use for financial. And so they've been doing it to minimize, normally the oil price goes up. But so they've been minimizing their tax bill by using LIFO. And if we adopt the international rules and they get rid of that, they're going to owe billions and billions of dollars of taxes. I read an academic article one time on it. The pharmacy industry does it. Pharmaceuticals also uses LIFO quite a bit. All right. There's a guy that sells cars that owns a number of car dealerships in town. I'm not going to say what his name is. He uses LIFO because he wants to minimize his tax bill. You know, most automobiles use specific identification because they know exactly which automobile cost them what. But he uses LIFO because it lowers his taxes. You can pick whatever you want. These are the options. Does that make better sense? Okay. All right. We're going to do another example, and this one is a little bit more simplistic, but I want to introduce, before I get to the last problem, what it looks like under a periodic inventory system. So we're going to do exercise number 12 on page 305. Has everybody got this now? Yes? All right. This is not a very good eraser. All right, on this one, it says the units of items available for sale during the year were, and it lists from January 1 how much inventory you had at what price, and then the purchase on February, July, and November. There were 220 units in physical inventory on 12/31. So they went out there. They sent some poor accountant out there on New Year's Eve to count. That's what they used to do. When I was with KPMG, Pete Marwick, they used to send a poor, and it was always the one that the managers did not like. They used to send them out to dip oil tanks on New Year's Eve to an oil and gas company here in town. So, those big, you got to get on a ladder and crawl up to the top of the tank, and you got a big stick that goes all the way down to the bottom of the tank. And it has increments on the side of it that tells you how many gallons of oil are in the tank. And so they used to go down there and dip tanks. Now there's truckers at the gate that want to dump their oil loads off so that they can go to New Year's Eve. And they're out there yelling and screaming and blowing the horn. And here's this poor guy walking around with a stick, going crawling up to the tank and going, yeah, this one's got 800 barrels of oil in it. Go to the next one. I mean, 4 years I worked for him and never had to dip a tank. Make sure that the people you work for like you is my advice. That's all I got to say. Because those same guys would go do inventory at a warehouse in August. It'd be 140 degrees and they'd be in there counting stuff. It's just awful. All right. Okay, so this one, we're going to start with average cost. So we started the year on January 1 with 200 units that cost $60. And that's a total of $12,000. Then on February 17th, so this is January 1, February 17th, we purchased 275 units at $64 for a total cost of $17,600. Then, on July the 21st, 300 units at $68 for $20,400. And then lastly, on November 23rd, we bought 225 that cost us $70. That's $15,750. Add all that up, you have $65,750 worth of 1,000 units, even. And that is available for sale. All right? That's the total of everything that you have available to sell for the entire year. You still have 220 units left in the tanks with the stick, because that's what the guy told you. So if you have ending inventory of 220 units, that means you must have sold 780. See, I can do math. So if you have 1,000 units at a total cost of $65,750, how much on average does each of these units cost you? Well, you can do this in your head. 65.75. Right? Let's just put the decimal point there. Yeah? Does everybody see that? So if you have 220 units in ending inventory at an average cost of $65.75 each, that's a total of $14,465. That's the value of ending inventory. Everybody with me so far? So how much did you sell? How much did that $780 units that you sold cost you? How much is your cost of goods sold? Well, it's what's left, right? If you had in total 65,750 and you still have 14,465 left, then $51, is that right? That's not bad for an old man in my head. 51,700 or 285. I can calculate it. I can't read it. That's what you sold. So you only at any time have to either calculate under a periodic. You only have to calculate one or the other. How much did you sell, or how much do you still have? Because once you have that one number, you can figure out the other number by deducting it from the total available cost of goods available for sale. So what about FIFO? We have 220 units in stock. Under first in, first out, ending inventory, this is ending inventory. Which 220 units are they from this table? Under FIFO, under first in, first out, what did we do with the January units? Sold them. They came out of the candy machine. What do we have left? We have 220 units from that November 23rd purchase. Those are the units that we have still in stock. $70 each for $15,400. If we subtract that from the $65,750, we get $50,350 worth of cost of goods sold. Yes? Is this making sense? LIFO, we still have 220 units. Now we've been selling the newest stuff in stock. So that 780 units that we sold throughout the year came first from the November, and then from July, and then from February, and now all we have left is what? Well, we still have all 200 that we started the year with at $60. That's $12,000. Where did the other 20 units come from? The February purchase at $64 or $1,280. That's a total of $13,280. That's ending inventory. Which, if we then subtract that from the 65,750, we get $51, maybe, 740. I think that's right. 470. Yes? Keep looking at the one with the computer. Is that what that is? 13,000 from that is 51,470. 52. Oh yeah, okay. Thank you. I tried. Is this making sense? Yes? Does it make sense to everyone? All right. I was going to do one more problem, but what I'm going to do, because we only have 25 minutes left, I'm going to use that. I'm going to record the problem. I'm going to record online and post it this weekend, or this week, probably tomorrow. I'm going to do problem number 6-1A, 2A, and 3A. All right? I'm going to do that online and post it rather than put it up on the board. And that way I'll review the midterm problem. Does anybody not want me to do that? It's a trick question. Okay. And I'll post that like I did with the last time. Now, I want to emphasize something just before I get into this. On the Excel problem, and I made it a lot bigger on Blackboard, the Excel problem, you are to start with a blank Excel file. Do not start with the file that I posted on Blackboard. I'll know, and I'll send it back to you. Do not do that, okay? Do the other one. Start with a blank one. Okay, midterm 3 from last spring was this one. All right, I'm going to turn the recording off now.